Imagine an investor with the absolute worst luck in human history. Let's call him the most unfortunate investor to ever live. Over a 20-year period, every single time he saves up money and decides to put it into the stock market, he buys at the absolute highest price of the year. Literally, the exact peak right before a drop. Common sense tells you this man should be completely ruined. He did exactly what every financial guru warns you against. But here's the thing. The hard data shows that after 20 years, this incredibly unlucky man still ended up with significantly more wealth than the person who patiently sat on cash waiting for the perfect opportunity. How is that even mathematically possible? It completely defies everything we've been taught about money. Today, we aren't just going to solve this psychological puzzle, because at the very end of this video, I'm going to share a legendary, classified study that proves why the people who made the absolute most money in the market were people who literally couldn't do anything at all. To understand how this works, we have to look at the stories of 3 different people. And trust me, as we go through this, you're going to recognize yourself in one of them. First, meet Wendy. Wendy has a strict rule. She refuses to buy an expensive market. Whenever the stock market hits a new record high, she locks her money away and waits. She wants a 10% correction before she touches anything. Sounds smart, right? It sounds incredibly responsible. Then there's Bridget. Bridget has that legendary bad luck we just talked about. Every single time she invests her hard-earned savings, the market hits a temporary peak and immediately tumbles. She buys exclusively at the worst possible times. Finally, we have Carl. Carl never invests. He tells himself, with the upcoming election, high inflation, and global tension, it's just too volatile. I'll wait until next year when things settle. Well, Carl's ending is already written. Inflation quietly erodes his purchasing power every single day while he thinks he's protecting his capital. But the real mystery lies between Wendy and Bridget. Logic says Wendy should absolutely crush Bridget's returns. After all, Wendy bought the discounts and Bridget bought the peaks. But when researchers analyzed decades of S&P 500 history, the truth shocked almost everyone. The data revealed that Bridget, with her historically terrible timing, wound up with a significantly larger retirement nest egg than Wendy, who spent years waiting for the perfect dip. But why? Is the stock market a rigged game, or is there a hidden mechanism at play? Here's what nobody talks about. It comes down to a simple mathematical truth that Wall Street often hides from ordinary investors. We naturally tend to visualize an all-time high like the dangerous peak of a mountain, a place where the only direction left to go is down. But a healthy economy doesn't operate like a mountain. It operates like a staircase. One new high leads to another, which leads to another, which leads to another. A growing business is literally supposed to break its own records over time. While Wendy is sitting on the sidelines waiting for prices to drop, she is actually paying a massive, invisible bill. In personal finance, we call this opportunity cost. No one ever sends you a physical invoice for it, which is exactly why it's the most dangerous expense an investor can face. Think about planting a tree. Does it truly matter if you planted it on the hottest day of summer or a crisp spring morning? Not really. What matters is that 20 years later, you have a giant tree providing shade, while the person next to you is still debating where to dig the hole. Time in the market beats timing the market, every single time. But if the math is this straightforward, why does buying at an all-time high feel so terrifying? The answer lies in our evolutionary psychology. Think about the sudden sting you feel when grocery prices spike or housing costs climb. Our brains are biologically wired to remember financial pain far more vividly than gradual progress. Psychologists call this loss aversion. We look at a record-high stock chart and our survival instinct screams danger. But that's only half the story, and this gets even more brutal. Look at what happens when you try to sit out and time the market. Financial studies show that over a 20-year period, if you miss just the 10 best trading days in the market, your total lifetime returns are cut completely in half. Miss 20 best days? Over 70% of your wealth simply disappears. And here's the cruel irony. Those 10 best days almost always happen during periods of intense market fear, right when the media is screaming at you to pull your money out. Investors waiting for absolute certainty almost always miss the exact moments that build real wealth. So, what's the actual solution? The most reliable strategy is to remove human emotion from the equation entirely. It's a method called dollar-cost averaging. By automatically investing a fixed amount every single month, you stop guessing, you stop predicting, and you let long-term compounding do the heavy lifting. But there's a catch, and this changes everything. There is a structural shift happening right now that could completely compromise this entire philosophy over the next decade. It's a risk that almost no mainstream financial influencer is willing to discuss. All of the historical data we just discussed is heavily reliant on the U.S. stock market. But over the last 15 years, a remarkably small group of massive technology companies have carried the vast majority of the entire index on their backs. This is known as concentration risk. History shows us that no single sector dominates forever. True financial wisdom isn't about predicting what will happen tomorrow. It's about building a robust, diversified system that still works 20 years from now, even when tomorrow completely catches the world by surprise. But as I promised at the beginning of this video, the most shocking piece of data regarding human psychology and wealth is still on the table. A major investment firm, Fidelity Investments, once conducted an internal review to find out which of their account holders achieved the absolute highest investment returns over time. The result completely baffled their analysts. The top-performing accounts belonged to two specific groups of people: those who had completely forgotten their account passwords and those who were literally dead. Why did doing absolutely nothing become the ultimate wealth-building secret? The profound psychological lesson behind that study changes everything we know about money, and we're breaking it down in the very next video right here. Click to watch, and I'll see you there.